This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you are listening to episode 46. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review the Planet MicroCap Podcast on iTunes. It really helps provide feedback for me and spread the microcap message. For this episode of the Planet MicroCap Podcast, I spoke with Travis Wiedower from Wiedower Capital. I've been following Travis's blog for some time called Egregiously Cheap and reached out to him to see if he'd like to share his thoughts. The main point I wanted to talk about was this idea of CEO alignment with shareholders, why this is important to him, and why he, as it says on his website, and I quote, only looks at companies where the CEO owns a lot of stock, end quote. The goal for this episode is to learn why Travis pays attention to CEO and C-suite pay and stock ownership, and why that is part of his investment criteria. Thank you again for tuning in to episode 46 of the Planet MicroCap Podcast. Please enjoy my interview with Travis Wiedower, but first, a word from our sponsor.
A comprehensive streaming of market data, research, and portfolio management application for you. QuoteStream is a real-time streaming quotes and research system designed for the day trader, retail investor, institutional investor, both new and old. QuoteStream offers low latency, tick-by-tick data, advanced charting, comprehensive technical analysis, news, and research. With no software to install and no servers to maintain, QuoteStream is the ideal solution for you. Go to stocknewsnow.com and start your free 7-day trial. Click the QuoteStream banner in the header or real-time quotes in the nav bar to get started building and managing your investments.
For this episode of the Planet MicroCap Podcast, I have Travis Wiedower from Wiedower Capital on the program. Travis, welcome to the Planet MicroCap Podcast.
Thank you for having me.
It's great to have you on. So to start off here, what is your background and how'd you get started investing in microcap stocks?
Yeah, my investing journey began when I was younger. I played poker full time for roughly 2.5 years. And there's a lot of poker players that also invest on the side, so kind of got into it. There's a lot of similarities between poker and investing. And I really enjoyed it, but it was very much a hobby for several years. And then a few years after, I guess I was really enjoying it, decided to start getting serious about it. And kind of my first introduction to microcaps was through the Ben Graham net nets. That was when I first started to get serious about investing. I discovered those, and that was back in maybe 2010 or something, where there were actually some decent quality Ben Graham net nets, and I'm not really doing those anymore, but have kind of always stuck with the smaller small caps and micro caps. I found that's always been what I've enjoyed the most. I feel like I'm kind of searching for hidden gems and turning over as many rocks as possible. And there's a lot more scuttlebutt. I feel like there's a lot more scuttlebutt required in small and micro caps, which I mean that's the most fun part of investing for me is kind of doing obscure research and finding these little companies and unique things about them. And I'd say the final thing is I actually have access to CEOs and CFOs, which if I'm investing in like Bank of America, I would never have that access. And the smallest companies, hell, there have been some times where I just call up their corporate office and ask to talk to management, and sometimes you can get them on the phone that easily. So that's kind of cool, and just something a lot of us small investors don't really have access to normally.
So just to your background, okay, so you're playing poker for 2.5 years. Like, what did you see, or what was the influence that got you even just started in investing? I mean, did you just happen to come across a book? Was it happenstance? What was one of your poker buddies also an investor? I mean, what was it?
There are quite a few like hedge fund managers that started from poker. It's pretty crazy, actually. So I had heard about some and read about it. Didn't have any direct friends, but I just had some extra money from poker and was like, it's earning 1% or whatever in my bank account. Might as well try and do something with it, and started screwing around in the stock market on the side, and kind of got lucky from the beginning, and I guess it hooked me.
Gotcha. No, I was gonna say you're definitely not the first person, especially in our age bracket, because I think you're 20-something years old too. I mean,
yeah, 29.
There you go. I'm 28. So I think I've met quite a few people in our space that are they got their start in poker and more mind type games, and made that transition. So it's pretty interesting. And actually we're gonna get more into it a little bit later in this interview. So. So my next question then is, following that, again, just getting right into it, what are your criteria for a potential new investment? What are you looking for?
Well, one of the first things I look for is if a CEO is aligned with me. I think it's kind of crazy to invest in a company where the person who's in charge of the company has different incentives than I do. So that's one of the first things I look at is a proxy statement to see how much stock the CEO owns, and if he's a founder. I really, really prefer founder-led companies. Beyond that, I love companies that have a really long runway for growth, that have benefiting from very large industry tailwinds, industries that are just going to grow for the next 5, 10, or 20 years. It's, if you're a decent company in an industry that's seeing huge industry tailwinds like that, it's kind of hard, not to, kind of be taken along with those industry tailwinds. I don't like debt. Of the 9 companies I own, I looked at before we did this podcast, 5 of them have 0 debt. The rest have small amounts of debt. I bet the debt to equity ratio of my entire portfolio is like 0.1 or something. So generally avoid debt. When it comes to valuation, I don't focus on any ratios really. I mean, if you ask me what the price to book of any company I own, I probably wouldn't know one of them. If you ask me the PE ratio of any of the companies I own, I probably don't know any of them. It was kind of a aha moment for me some years ago in my investing career, when I realized that, it's kind of obvious, but the value of a company is entirely its future cash flows. It really doesn't matter what the trailing 12-month price to book ratio or PE ratio or whatever is. I mean, it's possible for a company selling for 100x to be cheap, and as Amazon has been for many years. And it's possible for a company selling for 8x to be very expensive. So, I don't, my valuations are completely dependent on the future and trying to figure out, what those future cash flows are going to be. And that's kind of going back. I love when there's a really long runway for growth, and
Really quickly, just to follow up on your previous question, what I wanted to know is what do you look for when you're putting together your models and you are putting together your valuations for these businesses? As you said, sometimes a company trading 100x might be cheap, or 8x it might be expensive. So, what are you looking for? How do you put it all together?
Well, the main thing I'm looking for is a company that, first of all, is going to be around in 10 or 20 years. That's, is not going to be bankrupt, or the industry is not going to be eliminated. And then just trying to figure out how I think that industry will evolve, over the next 10 years. And then if this company will be able to benefit, assuming the industry is going to grow. I would think that the best investors of all time, people like Warren Buffett and all the others who've gotten long-term, great track records, I really think it comes down to they're better at predicting the future than others are. Because, that's really the company's value is completely dependent on where it's going in the future. It doesn't really matter what it did in the trailing 12 months. Obviously that affects it, but that's not where the value comes from.
So I'm going to ask, I had a written question but what I really want to ask you is, and it kind of relates to what you just said, and it comes to when you're going about finding potential new microcap investments. And would you say that you kind of take a top-down approach? Like you'll look at the industry first to see if it's an industry that actually has runway, and then see what companies are within that? Or are you more of like I'm going to look at the companies first and, it's in those industries that I'm looking for. How do you go about doing that?
Vast majority is bottom up. There are some, sometimes I'll read about an industry or, hear about something that I'll that piques my interest. But in general, I'm looking through a lot of companies and, within 2 minutes, I have a decent idea of what their business is, and most companies will just immediately be next just because I don't like the business, I don't like the industry, and so definitely more of a bottom-up approach.
So I'm just curious, what industries do you like right now that you find interesting?
Well, in terms of as I was saying earlier, I like industries that have really big tailwinds behind them that are going to keep growing. And one company, I don't own it right now, but I've spent a lot of time on it recently, so it's at the forefront of my mind, is Trupanion, and they do pet health insurance. And it's interesting because the U.S.'s penetration rate for pet health insurance is like 1%. Historically, pet health insurance has been kind of crappy in the United States, whereas in more developed or in other first world countries, the penetration rate is anywhere from like 5 to 50 or 60%. So there's this huge growth, before they get anywhere close to these other countries. And I like that industry, but I don't have much. I only own 9 companies. I don't think I really have any industry like focus, if you will. It's not like, I love housing right now and I have 3 or 4 companies in housing. It's, kind of going back to that bottom-up approach. I've found 9 companies that don't really do anything similar, but I like kind of their industries separately.
Gotcha. So you've actually touched on my next question a little bit, but I figured we'll pull it all together. How do you go about conducting your qualitative due diligence? Once you find a company based on your metrics, what do you do from there?
Well, in terms of management, seeing if this is a management team that I think is a high quality team, it's mostly conference calls. I think conference calls are one of the best, easy sources of company research and management research. So I generally will read the past 2 or 3 years of conference calls. So I'll go back to like Q1 of 2014 and read them all in order. And a lot of what I'm looking for in those conference calls is the CEO and the CFO, and kind of what kind of impression I get of them. And eventually I'll talk to them. And generally I don't talk to all managers, but in generally I like to. In terms of like company and industry qualitative due diligence, certainly look at competitors, suppliers, customers, trying to just understand this, assuming it's a new industry that I'm not super familiar with, just trying to understand the industry. If there are public competitors, obviously look at them, look at their conference calls and everything. I found a lot of microcaps, or at least the high quality microcaps that I really like, they're generally kind of doing something unique, and a lot of times they're the only public company in their space doing what they're doing. So there's, a lot of times it's hard to get great information about their competitors. You can go to their competitors' websites and stuff, but they're private companies. Industry trade journals can be a great one. It's kind of hit or miss, but some industries have really good ones where you can get really great industry information. And online forums have honestly been great at times. There's a company I used to own, Expel Technologies, that I don't own them anymore, but they do a plastic film or paint protection film for cars. So if you own like a $200,000 Ferrari, you can spend $2,000 to have it wrapped in this film that protects the paint and protects it from sun damage or rot chips. So I spent a ton of time going to like Ferrari car forums and Lamborghini forums and Tesla forums and all these different places where customers were talking about paint films, and got a lot of great knowledge about it on there. And then other online websites can be pretty hit or miss, like LinkedIn, Yelp, Glassdoor. I own a restaurant chain so I spent a lot of time going through every one of their locations on Yelp and seeing what the reviews were like, and kind of look at how they've evolved over time. Are the reviews getting better? Are they getting worse? LinkedIn can be great for finding. I found a great resource is past employees, which if you can talk to past employees, can be really valuable, because most employees, current employees of a public company, are well aware they're a public company. They know they're not allowed to say much of anything to outsiders. But if you find some past employees, they generally don't care. Realize that they're probably going to skew negative, so take some things they say with a grain of salt. But I mean, there have been times where I go on LinkedIn and you can search by past employers. So I'll look, whatever company I'm researching, look for past employees and see where they're currently working, and I'll just call up that company and ask for John Smith. And sometimes it works. Sometimes you can find these past employees. Sometimes you can, but I've found they can be very valuable.
That's a funny one. That's actually a first on the podcast anybody said. They go to past employees. I like that.
There's going to give much more honest feedback about company culture and what the CEO is actually like and that type of stuff. And again, they definitely skew negative because some of them have been fired or stuff like that. But yeah, I've found it to be very valuable.
I was going to say, I think there's going to be a lot of traffic on LinkedIn to past employers right now.
I hope I don't piss off some companies getting the surges of investors calling them.
They're going to put out a press release, be like, to all those investors who are calling past employees, please, for the love of God, do not anymore. Please stop.
Yeah, and sometimes, people just say, I have no interest in talking to you, or they'll assume I'm trying to sell them something or something like that. But there have been, other times where people are like, oh yeah, I'm more than happy to talk to you.
Cool. So on your website, and also as you've alluded to a little bit already in this interview, you said, and I quote, "I only look at companies where the CEO owns a lot of stock," end quote. So why do you only look at that? What's so interesting about that? Sorry, you don't only just look at that, but why do you also look at that?
Well, I pretty much only look at that. Okay. First of all, the only exception there is when maybe like a hedge fund manager won a proxy contest and he's now on the board and he's clearly in control of the company, or one of the companies I own, there's a private equity firm that took the company public, and they clearly control the company. But I mean, basically, I'm looking for whoever's in control. They are incentivized by the stock price, which the vast majority of the time it's the CEO. But it really comes down to just basic human incentives. Reading Poor Charlie's Almanac was a huge influence on me years ago, and I kind of became obsessed for a period of time with reading psychology books and books about cognitive biases and incentives and all that stuff. And once I was reading and learning about a lot of that stuff, first of all, I recognized a lot of the stuff in myself, and I realized and then you start to pay attention to other people, and just wow, these incentives are just so powerful. And what it really comes down to is human beings are selfish. I mean, human beings, our two basic instincts are to procreate and then our own survival, and kind of.
And self-interest isn't necessarily a bad thing either.
No, there's a whole lot of benefits to that. I mean, that's kind of what capitalism is based on. People being selfish.
You know what? I just started business school 3 weeks ago, and I'm going to start throwing out phrases already. So the rational actor paradigm, bang. There it is, paying off already.
There you go. So I mean, I want a CEO who, preferably they're the founder, so they invested their own money and, they own a decent amount of stock. But a CEO who is just kind of sitting on my side of the table and wants the stock price to do well over the next 10 years, whereas a lot of hired CEOs who own a very small amount of stock, or they were the stock they do own is just through stock options that were just gifted to them, they're not going to be nearly as incentivized by that long-term stock appreciation.
Right. So what then is your ideal CEO pay and stock ownership?
The biggest thing is that their stock is worth many multiples of their kind of cash incomes, whatever their salary plus cash bonus is every year. In terms of the microcap space, I think every microcap I own, the CEO owns or makes between like $150,000 and $300,000 a year, which I think is perfectly reasonable for small companies. If a microcap CEO is making like $500,000 or more, I'd start to get concerned. And then in terms of ownership, again, the ownership's more based on what their kind of salary is and stuff, but somewhere in the range of like 10 to 30%, I think is a nice number where they're, certainly motivated by the stock price, but they also don't own a controlling stake. So, someone who owns 20% knows that they're in charge, they're very incentivized by the stock price, but they also know that, hey, if I piss off shareholders, it's possible for them to run a proxy and kick me out because I don't own 60% of the stock.
That's interesting. So you'd prefer them not to own 51%. You don't want them to have too much where they can there isn't much incentive, you would say, because, while they own a ton of shares, there isn't as much incentive because it's not like they're, looking over their shoulder just in case they, there's lackluster, revenues for that quarter or something.
Yeah, exactly. And, once someone owns 60 or 70%, they can, of course they still care about the stock price, sure, but they can also just, pay themselves a huge salary and just kind of use the company as a piggy bank. And I do own two companies that are controlled companies. In general, that is something I avoid, but there are some exceptions where a founder started a company. He can, as they went public, he continued to own over 50%. But if someone's proven themselves over many years to care about shareholders and stuff like that, it's something I'm able to excuse, I guess. On my website, I'm pretty sure I linked to it on my website, but there's a research paper that looked at CEO stock ownership and the stock performance of those companies. And it's interesting, it follows a bell-shaped curve. And I was actually surprised that the bell shape peaks just over 50%. Like it peaks around like 55%. So stocks where the CEO owns, no stock, those are the worst performing stocks. And the best performing stocks are where the CEO owns like, just over 50%, right around there. And then it kind of quickly drops off after that, kind of what we were talking about. If someone owns 90% of a company, they can just do whatever they want.
That's interesting. I'm gonna get a link for that because I'll make sure that we link to it below this the audio.
Okay.
So then my next question then is, when you see a company that you think is a good business, but the CEO has this either a small ownership stake or just way too much, I have three follow-up questions. Does that, I can kind of guess your first answer, but does that dissuade you from potentially taking a position? And have you ever addressed this to management? And thirdly, if you did address it to management, how did you go about doing it? And what was their reaction?
Generally, that is a deal breaker for me. If the CEO owns a very small amount of stock. So I don't remember any instances where I did enough research on a company where the CEO didn't own any stock to really get to the point of addressing it to management. Like I said earlier, one of the first things I do if I like the basic industry and company is I'll go to the proxy statement and look at the ownership and the salary and stuff. So if it's a hired CEO who owns, very small stock that was just gifted to him, it's almost always just an immediate pass.
And Well, let's say let's say it's a company where the CEO owns, in your sweet spot, that 10 to 30%, but let's say he's making $500,000, or he or she is making $500,000, and you have concerns about that how much they're making on a paycheck standpoint. What have you ever had to address management in those cases? And if so, like what would you do? And even if you haven't, like how would you go about doing it?
I have never addressed management about something like that. Honestly, like by the time I get to talking to a CEO, like usually by the time I talk to a CEO, it's, I've spent weeks or months on the company. I've followed them for a long time. I already know a ton about them. So I obviously like the company a lot. I'm fine with everything. So I'm generally not, I have no desire to be like an activist or investor or anything. That's just not my personality at all. So, almost all of my interactions with management is, generally very positive. I'm not, I might make, small suggestions or something, or, kind of suggestions through questions, but, I can't really think of instances where I've really addressed like, something big that I just disapproved of or something like that. Again, if there's something like I dislike that much about the company, I'm just going to pass on it and not really get to that point.
Got it. Well, you know what? Everybody has their levels, or not just levels, but their metrics that they look for, and for you that is, if they're not meeting your criteria when it comes to CEO pay and stock ownership, it's just you're disciplined. It's a simple pass,
Yeah. Well, I try to be.
Well, we learn from our mistakes.
Yeah, absolutely.
So other than CEO pay and their stock package, what are some of other management intangibles that you look for?
One of the main things I look for, and it's so simple, is just management that is like straightforward and seems honest. CEO that talks about struggles, talks about mistakes. It annoys me so much when a company has like a below expectation quarter and they just start blaming it on the weather and blaming it on, there was, the presidential election was this quarter and people were staying indoors more. And I mean, which a lot of companies use that excuse, a couple quarters ago. Yep. I appreciate it so much when a CEO just says, hey, I made a mistake, or we didn't perform as well as we should have this quarter. I did this dumb thing and I learned this from it and I won't do it again. And, it really comes down to a CEO that just like comes off as a normal human being. There have been so many CEOs that either like on conference calls, certainly, or, a couple that I've talked to where like, I feel like I'm talking to a computer that just generates perfect shareholder-friendly responses to everything. And it's just like, it's so frustrating. That's one thing when I talk to CEOs, I purposely ask them, about like mistakes or talk about like times where they weren't good. I really look for CEOs that just kind of seem intellectually honest, I guess. And then on top, another big thing is CEOs that are more long-term oriented. And again, I find this correlates very high with founder-led companies, whereas a lot of founders are very focused on their company 10, 20 years from now. And reading conference calls, you'll see some CEOs will talk about, we're doing this to build our competitive position a decade from now. Whereas a lot of CEOs are really only focused on giving quarterly guidance, or they're only talking about the very short term. And that's certainly that's always a turnoff for me. Mm-hmm. I really like CEOs who kind of buck some of the Wall Street trends, or like don't give quarterly guidance at all, don't give annual. I love CEOs who don't give any annual guidance. But ones that give only annual guidance, or even some don't do conference calls, and sometimes that's for bad reasons. But sometimes you talk to them and they're like, I just want to focus on growing my company's value and I don't want to waste time doing conference calls and kind of tending to Wall Street's expectations and all these things. And as long as if some CEOs who don't do conference calls, as long as they're still open to talking to shareholders and seem friendly, I'm fine with that. Whereas some CEOs don't do conference calls because they view shareholders as their enemy. But
well, it's interesting that you look for that, because it seems like for some microcap companies, they won't put out that guidance, and it's almost kind of like does this mean that they're just gonna destroy all of our expectations, because they're mostly held by retail investors that have done their modeling, and they can kind of forecast where they think the company is going, and then they put out their numbers, and the next thing you're like, oh man, this is even better. And I can understand why you would like that, because you'd see that, and then probably next thing everybody who's been following the company is now coming in late, and you already owned a little position, and the next thing it's going up and up, and you're like, oh, this is fantastic. Great.
Absolutely. I read a book recently, which I can't remember the name of the book, but it compared Wall Street guidance to getting on a treadmill. And it said once a CEO gets on the guidance treadmill, it's impossible to get off. You have to, if the company has 8 great quarters, you have to keep beating that. You have to keep beating it. And it's impossible to manage those expectations down. Once Wall Street has big expectations for you, you can't come on and say, oh, well, growth is going to start slowing. And I mean, you can, but there's just no smooth way to do it. And at the point of that section of the book was just once you get on that guidance treadmill, it's impossible to get off. So it's better to just never get started.
It's like I was gonna say, it's like Twitter. Once you get started, and you're just like, damn it, I cannot stop using this. So, oh man, that's funny. Actually, what you just said kind of leads into my next question regarding your one of your blog posts called "Why I Avoid Acquisitive Companies." Because you would think once that growth starts to slow down, they might be looking for acquisitions to try and grow the business. So can you explain then why you would avoid these types of companies?
The number one thing is that they're harder to analyze. A lot of acquisitive companies, especially if it's like a roll-up where they're buying a ton of companies, it's impossible to get an idea of what the organic growth rate is. So you basically have to trust management. Whatever if they mention organic growth rates, you have to trust them. There's just no way to confirm it. And as I've talked about, I vastly prefer to invest in managers who I do trust, but I also want to be able to confirm what they're saying.
How do you confirm organic growth rates when they're about to acquire a business?
Yeah, exactly. And, those financials can just get so messy. It's much easier for managers to kind of hide things in those financials because they do get messy. And then on top of that, the research has shown that acquisitions don't generate shareholder value for the acquirer. So research has shown that acquisitions and mergers create value, but all of that value goes to the acquired company. And that's because the typical premium for an acquisition is around 30%, and that's just an average, of course. But so when you think about that, if I buy a company, I have to increase the value of the new combined entity by 30% just to break even on that acquisition. That's 30% significant. And then on top of that, the combined entity has to, create 10 or 15% more value per year, whatever it is, to make that attractive IRR, to make it even worth it in the first place. So, just from the very beginning, just looking at it from a high level, the numbers are against you when you're acquiring a company. Now, of course, there are a ton of exceptions, and generally small bolt-ons do perform much better than large acquisitions, and where you have to take on debt and stuff. But just in general, I do own one company that I would consider acquisitive. But most of their acquisitions have been smaller. They've never had to take on debt or anything like that. So it is something that, like, if I'm reading an investment write-up and in the first paragraph the author says, like, this company is rolling up this industry, I usually just stop reading right away. Like, I very much avoid roll-ups.
Or do you look at also, does this also include those companies that are like, we have the public entity and then, we're now buying up these smaller private companies to fold into and help them develop to a certain point? I mean, does it include that as well?
Yeah. I mean, I generally avoid acquisitive companies. Like I said, there's one company I own that's purchased maybe 6 or 7 companies over the past, I don't know, decade or something like that, which still isn't super acquisitive. But besides that, the other companies I own, have made very, very few acquisitions.
Mm-hmm. So, do you prefer having a concentrated or a more diversified portfolio, and why?
Well, as I said, I only own 9 stocks right now, so I definitely prefer concentration. But I don't know if that was ever a conscious decision. Like, I don't know, 5 years ago, I was like, I really like owning 10 stocks. This is what I'm going to do. I really think it's more just a function of time. I'm only one person. I don't have any analysts or anything like that. So I only have a very limited amount of time to research stocks. So I mentioned Trupanion earlier, which I've been spending a lot of time on, and again, I don't own them, but I discovered that company maybe 5 weeks ago, and I've spent a very significant amount of time on them for the past 5 weeks. And next week I'm flying up to Seattle to go to their annual meeting. There's a whole lot of things I like about the company, but my point is that by the time my research is over, I'm going to spend 6 or 8 weeks on them. And of course, I've looked at other companies, I've done other stuff in that time period, but a significant portion of my time the past 5 weeks has been researching Trupanion. So in a year's time, how many companies can I really look at in depth? 10 or 20 or 30 or something like that. There's just no way I could own 50 stocks or 100 stocks because, on top of the research I'm doing, I'm also doing kind of maintenance research on the companies I own and keeping up with their releases and, if anything changes in those industries or anything like that. So it's just, it's just not realistic for me and my investment style to own, really more than I've actually, I think a year or two ago, I owned like 12 or 13 stocks, and I've kind of tried to trim that down. I really think like 7 or 8 is my kind of preferred number. And again, kind of similar to answer my last question, people, I'm going to cite some research that I also have linked on my website as well, by the way. But the people like a diversified portfolio because they like the lower volatility. Mm-hmm. That's the main reason to own more stocks. It's just less volatile. But the standard deviation of stock portfolios is subject to diminishing returns on like a massive scale. So if you look at this paper that I've linked on my website, it shows that the average 2-stock portfolio has a standard deviation of around 50%. The average 10-stock portfolio has a standard deviation of 19%. And then the average 1,000 stock portfolio has a standard deviation of, I have those wrong. 10 stock portfolio has a standard deviation of 24%. Mm-hmm. So it's basically cut that standard deviation in half from owning 2 stocks to owning 10 stocks. And then going to 1,000 stock portfolio only brings the standard deviation down to 19%. Mm-hmm. So going from 10 stocks to 1,000 stocks only decreases your standard deviation on average by like 5% per year. Mm-hmm. And owning more stocks massively increases the amount of work you have to do for a very small benefit.
Right.
And decreased volatility.
Right. I was going to say, with the amount of work that you put in for each of your portfolio companies and to find a new portfolio company potentially, it's a lot of it sounds like you put a lot of time and effort into it, and
and
even then, that's still no guarantee that you're actually going to, deploy a position.
Yeah. There are times I spend a month or two on a stock, and I just add it to my watch list, and maybe I'll buy it in a year or two.
Right. So, actually, I'm taking a quick 180, and going back to your background, and because I want to know, like how did your poker playing skills lend itself to investing, especially microcap investing? What's the common denominator there?
Well,
and don't just say gambling.
No. Well, poker's not gambling, even though the U.S. government thinks it is. I have to put that out there. But it has a lot of similarities in that. First of all, I think the biggest benefit I got from poker is having a long-term orientation. So in poker, I can get it all in this hand with pocket aces and have an 80% chance to win the hand and lose. But I have to tell myself, hey, if I did that, 10,000, if I play this hand the exact same way 10,000 times, I'm going to make a ton of money. So in poker, and you kind of train yourself to just not care about the short-term results, or not care about the hand. As long as you're making good decisions, you're going to make a lot of money in the long term. And it's similar to stocks. There are a lot of things that can go wrong in the short term, but if you're focusing on the long term and finding companies that are going to do well in the long term, the end result's going to be good. Even, there's always going to be bad quarters and always going to be, general stock market movement. So that's the biggest benefit. And, there are, you joke not to say gambling, but certainly poker, investing similar to poker on just like a much, much longer time scale. Like poker, you're, putting money in and, getting results like every minute, every time you play a hand. And then investing is kind of similar. You do a lot of research and then you make a bet, and, it pays off in 6 months or a year or 5 years or something, but it's kind of similar concept. And, I bet all investors, or most investors, have to have some, someone who is super conservative with their money and just keeps all their. I have a friend who's very successful, quite wealthy. He has almost 100% of his net worth in his bank account, earning, basically nothing right now, just because he's so conservative. Like he doesn't even want to put it in an index fund. He doesn't want to do anything. So, if you're investing in individual stocks, or you're investing in, even index funds, you have to have some element of, you're clearly willing to risk your capital to make, essentially make a bet on something that you believe in. Now, you may not be a gambler, quote unquote, but, I think some element of investing is, you're willing to gamble your money.
Mm-hmm. So, okay, getting back to your current more recent events. You did publish on your website your 2016 shareholder letter, and you discussed at length how you had a clear case of cognitive dissonance. And what I want to know, because I've heard this phrase come up sometimes at cocktail parties and whatnot, and what I want to know is what do you think, to you, what does this phrase mean, and why do you think we are all susceptible to this as investors?
So cognitive dissonance to me is basically when a person holds two beliefs that contradict each other, and even though they believe both things, or they have or it's like a belief and an action or something that contradicts their belief. But kind of how this is kind of based on what I think Charlie Munger calls the inconsistency bias or something, whereas humans hate being inconsistent. Like, I want to appear to others to be very consistent in my beliefs and my thoughts and my actions. So when we have these beliefs that contradict each other, we somehow reconcile those in our mind. And it's usually by, lying to ourselves or, kind of telling ourselves half-truths or whatever, just to kind of justify this thought or action that contradicts, what we believe. And I was listening to a podcast a couple months ago. I'll kind of throw myself under the bus to give an example, which I think cognitive dissonance is easier to understand when you an example. But anyways, I was listening to this podcast, and this guy in the podcast started talking about this case of cognitive dissonance, and I was like, holy shit, like I am so guilty of that. And it's something I'd never really thought of. But he was talking about animal cruelty and people who eat meat. So I will say that I love animals, I'm against animal cruelty, as the vast majority of people do, but then I also eat meat and support meat packers and an industry that has been proven to treat animals horribly. So what do I do to justify that? I think the main thing people do is I just don't think about it. I don't watch those documentaries that show how horribly animals are treated in meat packers, kind of that whole out of sight, out of mind. And then, I might tell myself, it's natural to eat meat. Humans have eaten meat forever, and that's how the food chain works. Other animals eat other animals, so, humans eat animals as well. And, those cows are bred specifically for this purpose. And so there are a lot of little justifications we can tell ourselves to kind of reconcile the fact that, when it comes down to it, in a very small way, I am supporting that industry that has been proven to treat animals very poorly. Mm-hmm. To relate that to investing, I think cognitive dissonance is just one of those things that it's just a human trait. I don't know if it specifically has anything to do with investing, other than that I think all humans are guilty of it in a lot of ways. Have a discussion with someone about politics and you'll see cognitive dissonance through the roof in terms of, someone believes something, but their candidate believes something else, and they try and justify that. And
I guess sorry, I didn't mean to cut you off.
No,
but I would think like a good example would be, let's say like you happen to invest in a company where, okay, let's say they're making money, like they fit all your fundamentals, but it's a company that's, you fundamentally are like, let's say you're not a soda drinker, your whole life, but next thing you know, you're looking at a soda company and it's like, oh, look, it's checking all my boxes. I'm going to take a position, and that's a perfect example that, you could very well say like, I don't drink soda because sugar's bad for you. And I think, I think the government will eventually take action against sugar because it's bad for you, and the government wants to protect people against sugar. And, eventually more people are gonna, just become water drinkers and things like that. But then you discover this company and you might, you like the financials or whatever, and it's kind of easy to throw some of those, just kind of push some of those beliefs under the rug, if you will. It's hard. Part of you, like, especially if you're an outspoken, like, I'm never going to feed, my kids will never drink soda, or, they're not going to drink fizzy drinks. And yet here you go, you're building your wealth with, owning stock in a sugary drink business, like, it's a tough one, because on one hand you're thinking to yourself, well, I'm building my wealth, I'm invested in a good company that's growing at a steady pace, blah, 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 hitting everything I'm looking for. But at the same time, you almost have to like really weigh what's more important to you. And I think that's more, and I use this phrase not saying it's a bad thing necessarily, but it's more of the irrational mind in a sense. You're not thinking about it rationally in the sense that, if you were looking at it objectively, you see, okay, one hand building wealth, other hand not building wealth. It's more like on one hand, I don't like sugar. I don't believe in sugar, and yet, I'm in this sugar company. I don't know. I'm just kind of spitballing some
yeah, no,
thoughts on it.
absolutely. And that's something I've started to think about maybe more in the past year, something that, I certainly prefer to invest in companies that I think are doing good and are making the world a better place because, one, it kind of makes me feel good or whatever. But two, like those companies, all things being equal, I think those companies are going to do better than, a lot of companies that are damaging the world or, damaging the environment or, it could be 1,000 different things, but whatever it is.
Yeah. Well, no, that's a good point. I mean, at the end of the day, like, it's the world is constantly changing, and we want to look for companies that are, we think are making the world a better place. And look, as investors, that's our way we can help, make the world a better place is by investing in these companies and supporting their efforts,
Yeah, absolutely.
So, this is a fun question that I love asking, and can you recall an experience that helped guide your current microcap investing philosophy? Was it a conference call or what can you name an experience where you're just like, wow, CEO pay, screw, damn it.
I referenced Ben Graham earlier. That was definitely one of the earlier, educations I got in investing. And obviously Warren Buffett, I've read, as we all have, read a ton of stuff about Warren Buffett. And it was it's interesting because the value, theory, if you will, stuck to me right away. But I certainly invested in, plenty of crappy companies that, looking back and like, why would you ever invest that? Why would you ever invest in those? Those are clearly terrible companies. But another like aha moment I had, and I don't even know why it was, I should have saved this, but I was reading one of Alan Meacham, I'm not sure how you pronounce his name, very successful hedge fund manager. I was reading his shareholder letters years ago, and for some reason, he just put the whole value idea just like very simply in a way that kind of stuck with me. And it like, just if you invest in like high quality companies with trustworthy managers, you're going to do all right over the long term. And it was more to it than that. But for whatever reason, however he put it, kind of stuck with me more than how Warren Buffett has said it so many times. And I wish I could reference. I don't even know what shareholder letter it was of his, but I've read them all. Yeah, that kind of, and that's not microcap specifically, but just investing in general and just like high quality companies that are gonna be around in 10 or 20 years, led by trustworthy management. It's very simple, and Warren Buffett's been preaching it for 50 years, but when you actually go look at, you look at some company that's selling for 8x and half a book value, and you're like, oh, but this is so tempting, even though the CEO's done a shady thing or two, and the industry's declining a little bit. But it's so easy to get tempted by those, as that's where most of my investing mistakes are. Whereas in like caring about the valuation more than the quality of the company.
Right. So then what is your advice for new microcap investors? If you're a fresh youngin' or olden, just getting into the space, what type of advice would you give them?
It is so easy to get blown up in the microcap space. Investing in companies that appear, cheap or, high quality or something. Almost every small cap, microcap CEO is a good salesman. And they're personable, they're enthusiastic, they think the company is going to be $1 billion company someday. And a lot of them are very convincing. But I feel like, certainly myself and maybe other investors as well, like if I just required myself when I was starting out to only invest in profitable companies that didn't have any debt or had like very small amount of debt, I probably would have saved myself a lot of mistakes. Like just looking, like just those, if a company's profitable and it doesn't, there's very little chance it goes out of business or anything. Maybe their advantage will get eroded away or something, but you're probably not going to just get totally blown out of the water.
And it's not the worst thing in the world to have a loss,
Oh, no, that would be my second piece of advice is to, just invest your own money and, accept that it can be so, as I still make mistakes every year, every investor does, but just recognize that every other investor makes those mistakes as well. And, don't beat yourself up over too much. And you're probably not going to get that education unless you're investing your own hard-earned money, because it definitely feels a lot better, or it feels a lot different when you lose your own money versus, you read about someone else's loss, or you're investing in a fake account or something like that.
Hey, for full disclosure, I was pointing at myself when you said So Travis, where can my audience go and find more information about you and Wiedower Capital?
I generally just point people to my blog. So I run an investing blog at egregiouslycheap.com, and it's focused on small micro caps. So I'll post investment ideas there, and also, as we talked about on this podcast, a lot of just general investing topics and theories and stuff like that. So egregiouslycheap.com.
And are you on social media? Do you have a Twitter?
I do have a Twitter. I have never tweeted before.
This is going to be your first tweet right now.
Yeah, maybe. I use it. I follow a handful of investors, and then I follow some companies I'm invested in. I'll follow their Twitter account, but I've never had something to tweet about thus yet. Most of my investing thoughts I just form into a blog and write it on there. But
dude, you got to share it on there, man. Come on, dude.
I'm a very bad tweeter. I don't know.
Hey, man, this is social media 101, dude. Come on, man.
It's really funny. My girlfriend actually works for Facebook, so she loves social media. Most of her friends obviously love social media, and I'm like not on social media at all. Not really a user, so she always harasses me about it.
Man, that's so freaking funny. I think she has cognitive dissonance dating you right now.
Probably. Although she would not want me on Twitter, that's for sure.
No, yeah. Oh, man, that's funny. And guess what? We went through this whole interview without making one Wiedower pun. So I'm gonna pat myself on the back right now. And
congratulations.
And Travis, thank you so much for joining me, man. I really appreciate it.
Thank you very much. That was fun.
Thank you. Thank you all for tuning in to the Planet MicroCap Podcast, and thank you, Travis, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@snnwire.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the Microcap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.